Welcome everyone to the Actions to Wealth weekly market update. I'm Gordon Scott. I'm here because I'm not only going to talk a little bit about the Forex markets, but also the US stock markets and give you my background and expertise on that area as part of today's market update. And I hope it's useful for you. I think that there's a lot of interesting things that can be said here right now about what's going on with the expectations for geopolitical movements and so forth. I think that's playing into the market pretty strongly. So hopefully I can share my screen here and we can look at a couple of charts and give you some insights that will help you out. This screen I have here is just a list of trading edges that I typically talk about that are available in the market. Hopefully you have worked with Actions to Wealth and things like the Wave Runner and various other tools that have a built-in trading edge to them. Lloyd's been very good at researching good entries about those, but regardless of what edge you use, then you have to have your appropriate way of trading it, whether that's Wolf or Jaguar or whatever, right? I'm going to come back to this slide in a moment here, but the first thing I want to do is have a look at the Euro USD pair with my own way that I like to look at the markets with these Keltner channel bands. Okay, and what a Keltner channel band is just a marker. It starts with the moving average. In this case, it's the 25 period moving average. This is a 4-hour chart, so we're looking at something that's what's that going to be? 25 minutes. It's like a 4 or 5 day moving average is what that line would end up being on a daily chart. In the 4-hour chart, as we have here, it's a little longer than a 20 period, but you get the idea. It's that moving average. Then each band going up is 1 ATR higher. So +1 ATR above the moving average, +2, +3, and then -1, -2, -3 in the green lines going down. And I developed this system of looking at prices in this way because I wanted to know how much down. And is too much. I developed this when a price moves a certain distance, when do I think it's possible that it could snap back? And what I found is that outside of that +3 or -3 lines, it's a really good chance that you might see a snapback at some point. Okay, and so what you're seeing on the chart here is the Euro USD all the way back into the ending of November, and right here in the middle of the charts, the beginning of the year. And notice what happens, that we're sort of uptrending on the Euro USD, and then all of a sudden it comes down, and then rebounds right back up, right at the start of the calendar year. Well, I find it interesting that two particular things happen. One, we got outside the -3 band, and we hit this 100 period moving average. Notice how we got outside the -3 band, and then the next time, we kind of played around in the -2 band, but we failed to hit that -3 band. And that's why I like this method, because you see that happen and you realize there's buyers stealthily coming in here and kind of propping up the price. And sure enough, up it goes after that. All right. Notice the difference when it happens again. This time it comes down, comes through the -3 line, and that tells you, okay, hey, that's maybe too far. Maybe we're gonna get some rebound. But notice that when it did that, instead of being above the 100 period moving average, we're now below it. And when we come back up to that, all of a sudden, very clear resistance happens. And then we even break through above, but it finds resistance right on that, 25 period moving average. And again, we see this attempt to run up, and down it comes. Well, from these points, what you see is the price building into a downward trend that we're definitely in right now. See, and we're making lower highs and lower lows, and we did not close outside of the -3 band yet. Probably some chance that it will continue going down in the coming week, before we get to a point where we'd say, hey, maybe it's time to anticipate the reversal on this. And so right now, we're just simply looking at the possibility that we could see more continuing low, because when it breaks that -2 band, see, that's not a reversal. It could reverse at any point, but typically the -2 band is not a place where you see reversals. The -3 band, from bearish to back up to bullish. Here you see the -2 band, and although it does reverse, it doesn't reverse the bigger trend. See, so as long as we're here and on the -2 band, we're still in for continuation. At least, it might fluctuate, but better odds betting on the downside move. And you can kind of see that. Step back, think from the news and geopolitics and stuff. There's a lot of scary stuff that's going on out there. The talk of continuing Russia-Ukraine conflict, the talk of escalating Chinese-Taiwan conflict, or not escalating, but actually occurring at some point. Just rumors. Nobody knows anything for sure about what would happen there, but it isn't. The market isn't about knowing. I mean, the market pricing isn't reacting because they know something's going to happen. Investors are just a little more worried than they were before, right? And that's the point. We're seeing a lot of worrisome news sort of bubble around, and it's in fact affecting investors, and they are more likely to be sellers than buyers, both in the Euro USD and in the US stock market right now. The Euro USD and the stock market, they're not a mirror image, but they do have a high degree of correlation, usually anywhere from 70 to 80% correlation. So if in fact we see this trend continuing and likely to continue downward on the euro, then we'll probably see that in the US market as well. Now, I have been, up until this weekend, much more interested or much more prone to consider the ongoing movement in the markets as much more more likely to be bullish than bearish, and there's still a possibility for that. However, the past couple of weeks, the movement has just been so persistent to the downside that it made me dust off my sector chart. So this spaghetti line chart is all of the sectors in the U.S. market and a few other assets like bonds, small caps, mid caps, agricultural commodities, hard commodities, gold, and of course the euro. So it's hard to look at these lines exactly and just know how to pick them out unless you get used to what you're looking for. And what I'm looking for is stuff that back here was kind of on the bottom, but now has kind of moved into the middle or even the top area, if in fact that is. Also, I want to know what's on the top, and is it rolling down? Is it dropping below the previous highs? Are we seeing a rotation of leadership, they call that, in the performance of different sectors? Okay, so here we see this is the communications sector. That's going to be stocks like Google and Verizon, and advertising companies are in there. And there's the price of gold, right? Both of these were leaders over the past 3 months, and they're now starting to turn down. But even though they're turning down, they're holding on to their leadership position. What could overtake them? Well, that line right there. So if I click on that, I can look over here and see that's basic materials. Okay, so companies there include Lind, Air Products, Delivery, companies that make dirt, air, water, or that work with that. So why is that one overtaking? See, that's the important question we should be asking. We want to see if mostly everything's going down, what's going up? What does that tell us about what the market thinks? Here's a line in here, this little green line. You can see it's kind of cutting across the swim lanes and moving up. Let's look at what that is. That is DBA. That's an ETF that tracks agriculture. So soybeans, wheat, corn, live hogs, cattle, live cattle, stuff like that. Not live hogs, pork bellies. Anyway, futures that are in the commodities area, in the agricultural area. Why does the market care about bacon right now? You know, I mean, what, always cares about bacon, but why does it care about seeing the price of agricultural commodities move higher? What's the trend here? Here's another one that's sort of going up and over. What do we got? That's actually technology. It started to go high, but it's come down, but it looks like it's kind of hanging in there. Hard to say those lines, how they cross over. Maybe what I'll do is I'll make a change in color. Oops. To that line, the technology line, and then we'll be able to see it better. Okay, yeah. So the technology line was cutting across on the way down, but it's still kind of holding a position. And then this line here is the agricultural. And see, it was down low, but it's moving up and through, and now it's on the middle. Well, the big black line with the dots is the S&P 500. So anything above that is showing strength. Now, why is the agricultural showing strength? I think that if you put together the agricultural and the price of gold, and then there's this one we saw here, which was basic materials. All of those are things. You know, they're things, physical things. They represent physical items that have intrinsic value. And when inflation goes up, the price of these things tends to go up as well. I think what we're seeing here is that the market is telegraphing the chance of, or the occurrence of inflation. They think inflation is coming. Market participants are more worried about losing money to inflation, so they're looking for investments that can do well and grow in inflationary times. That includes agricultural products, the price of gold, and basic materials, right? Now, why is the market concerned about inflation? Well, it might just be because the inflation numbers are coming out soon, but it might also be because of the threat of war. War times historically aren't necessarily bad for the markets. The markets don't crash because of war, unless your country's losing, right? I mean, whatever. It's generally speaking, markets kind of hang in there through political and military conflict. And what does happen, though, is inflation, because the governments have to spend more, and that creates just more money in the cycle, and that just creates more demand for various goods. And so that inflation, the investors are worried about, might be showing up because the investors are expecting geopolitical conflicts to turn into geopolitical tensions to actually boil over and turn into wars. We have one major war going on that everybody talks about right now, but there could be more coming in the future. So that's interesting. If in fact you see inflation, then you see a rise, a rise in interest rates to counteract that inflation. And that means that you see US dollar going up. If in fact you see interest rates continuing to rise, then the US dollar is going up. And US dollar was going up for a little while as interest rates were going higher, but then it kind of stopped. Then interest rates, through last part of the year and early part of this year, interest rates have kind of been dying out. But now they're sort of resurging here, just mildly just in the past few days. So it kind of fits with the possibility that we're going to be seeing more inflation. At least that is the way that the market is willing to place their bets. They're trading as if they're going to be more inflation. And if I look big picture here, here's a comparison between the Dow Jones Industrials and the Dow Jones Transport. This goes way back to Charles Dow and Dow theory 100 years ago, that one of these two indexes will take off first, and then the other one has to kind of confirm the move, right? Well, we were just about to get up there and break into new highs on Dow Jones Industrials. We already had broken into new highs for transports, but then immediately thereafter, you get these 3 downward days, and this is what's happened in the Forex market since then. So you can see also this sort of falling off in the US stocks. It was poised to go higher, but that's been negated. So what we're looking at is a slight bit of weakness and maybe a possible top in the US markets, at least short-term top for now. All right. Now, then there was one other thing that really caught my attention here this past week. This is a chart of the home builders sector, or industry group, I should say, that XHB is right in the middle. If this thing is doing well, then the economy is doing well. And so far, I've been bullish on the U.S. economy because this thing hasn't shown, any kind of serious chinks. So I feel like this is very important to pay attention to, because if you have a home builder in the U.S. that is attracting a lot of investors, and its price just keeps going up and up and up, that's all those investors betting on a better tomorrow economically. They think that, hey, things are going to go better for the American consumer. We got to be there to profit from the houses that they will surely buy. But lately, a very interesting thing has been happening that I think should have made more of an impact than it has. This orange line is the stock price closing each day for a company called Lumber Liquidators. And think of Lumber Liquidators as the kind of a smaller scale Home Depot, but more to lumber and construction crowd, the professional construction crowd. So Lumber Liquidators, they have been losing a lot of money. And the story that they're sticking to is, well, gosh, we didn't know we were supposed to try and prop up our stock price. We're just trying to keep our business afloat. Here's the challenge that the lumber industry, and in particular Lumber Liquidators, has had. Most of the lumber that drives that industry comes out of a place called British Columbia in Canada. So the upper northwest edge of the 48 continental United States, going just north of there, and in the forests along the coast there, above Vancouver, Canada, those forests in that area are major outlets for a lot of the raw lumber that gets used in home building projects anywhere in the world, but especially right here in the United States, or in Canada. I'm sorry. And so you look at this and say, okay, if lumber prices are high, homes are not going to be built. People aren't going to want homes if, in fact, lumber prices are too high. But look what's been happening. Since October, November, this thing has been moving up in price. And so I feel like that is an early signal that, hey, the economy might be on the right foot. And we have, in fact, seen interest rates sort of trim back a bit. But All the while that is going on, lumber liquidators stock price keeps getting lower and lower. And I don't mean a little, I mean a lot lower and a lot lower. That is, what is going on? That's kind of surprising, because if the lumber industry or the home building industry is about to say, hey, everything's great, we're going to build a lot of houses, sell and make a lot of money, then the lumber supplier should be, yeah, we're all in. That's great. You build it, we'll make more. Just keep going. But they aren't that. And I heard it explained that the problem for lumber liquidators and any other timber company right now is that they have had such high costs that they can't and don't want to try to compete with selling at higher and higher prices. Well, it's not like they're altruistic, right? If they don't want to sell at higher prices, it's because they know they can't get higher prices. And if you can't get higher prices, it's a signal of just one thing. That is, if you can't get higher prices that are competitors or your customers, then that's just one thing that points to. And that is customer demand is weakening. And if customer demand is weakening, then this stock, Lumber Liquidators, is going to have some really hard times trying to figure out where it's going to get its next customers, which is why we're looking to hear it over the past year. Lumber Liquidators is down, 63, 64%. That's a huge drain. So I feel like the fact that here just in the past 2 or 3 days, see how Lumber Liquidators have made a new low. See how this area here has kind of broken the trend in prices. We're out on this island. And Lumber Liquidators during this period of time isn't going up in price. If the economy has taken a nosedive, then that might lead to lower interest rates, and lower interest rates would mean more buyers, right? But that's no. This variety of movement is leading to lower prices. So if it's lower prices, that means lower demand. And if it's lower demand, that could mean, hey, all across the board, we're not going to be able to find buyers for our stock. That's the bottom line. So I'm looking at this thinking, well, if in fact that happens, then what would I want to see out of the price coincident to let me know? I'd love to see a sort of rebound here, but we didn't. We got this crossover, and it looks as though it's already trying to signal trouble, right? Breaking down, working through it. Look, all of this on high volume. So that's the signal that really worried me. It's like, hey, if lumber is low, and it implies decreased demand for housing, then this thing up here is going to have to continue down. It's already stepped over the line, but it's going to have to continue going down. And if that thing continues to go down, then we might the S&P 500 in general make a turn for lower. It closed lower, it might continue to just close lower still. Now, where are we going to? How much is too much, right? Well, I like to use the Keltner channels for that. I'll take that away. Oops. Yeah, okay, there we go. I got rid of the strategy. Okay. So here we've got a Keltner channel. I want to change to well, let's just change to a different color. So we know what it is. We don't need that. We don't need that. Actually, we do want that one. That we don't want. Okay. And then I'll change the other Keltner channel. All right. Oh, shoot. I forgot to change those to +3 and -3. There we go. This is 3 and 4 going even further outside. I'll change that 20 to a 10. You may ask, why am I doing that? Well, because I want to find the volatility edge, right? Where is the point at which we would ultimately see support based on volatility? Like that, then the euro and the US stock market at large would also drop in like fashion. It'd be kind of hard to imagine that the euro was that affected by just what happens in the housing uh, sector, the housing industry group in the US. But don't forget, the housing is the housing industry group is connected to all of the mortgage and the mortgage-backed securities and the 10-year notes and et cetera, et cetera, et cetera. If in fact we're going to see a serious drop in prices in any of the currency markets, it's going to happen first in the housing, the U.S. housing industry group. All right, so now then, there's something that happens in, there's something that happens in stock markets that doesn't happen in forex markets, at least not nearly as often, and that is gaps. And what do gaps mean when they happen? Right? It's just a sort of, well, I mean, a lot of people wanted to put in orders before, but that made the price jump around. Or there was a study done on the importance of gaps and whether or not they can be effective in the markets for predicting the markets. And in fact, that study showed that gaps were a major factor, and especially gaps down towards a factor towards helping people understand how far is too far, right? When's the time that you buy the potential turnaround? So on this, if I zoom in on this one here, the gaps down strategy and that edge, then let me show you how well it works. From the time period of 2012 up until now, that's roughly 10-year period. You can see that this has 5 days of data. What this is a signal test report. And it has 5 days of data in front of the signal. And in this case, the signal is the gap down. And I'm searching for stocks that have gapped down more than 1% in the US stock market, right? Would this also happen to the Euro USD, like over the weekend? Because you can get weekend gaps. it does happen, and those gaps may or may not be meaningful. And since the currency has so many more traders than an individual stock has, then you just can't say what everybody is definitively thinking about them, right? But here's one where if it gaps down by more than 1%, and you wait 3 days, just wait 3 days, and then you buy that stock. What happens after you buy that stock? This green shaded area and the yellow shaded area tell the story. The yellow shaded area is what happens to the S&P 500 over the past 10 years. And the green is what happens to these stocks that are, liquid, large cap. They're the household names. It's Google, Amazon, Apple, Microsoft, all those kinds of stocks. That's what this is. And if on one of those occasions where that particular stock in question dips below the -3 and you happen to buy and just hold and wait, then look what happens. After about 15 days, and these are averages. These are averages of all the 30,000 times this happened. Okay. What you see here is there is a bona fide edge. You're looking at this sort of thing and you're thinking, there's no stop losses here. So I just want to win more than 50%. And we do. We end up winning down here. Probability of gain is 71.24. And sorry, I accidentally went forward on that slide. 71.24. Now, if you just sit back and hold the index, you have a higher chance of the index going higher, but not as much. Look at the mean return numbers down here. The mean return is 4.48, and the mean return for the signal that I'm describing, anyway, it sort of languishes for the first week or so. See, it doesn't get anywhere, but then all of a sudden it starts taking off, and it has separation from the yellow. So that's a measure of the outperformance of the average move in the market. That's kind of what you think of the yellow as, the yellow shade. All right. Does anybody have any questions? You're welcome to sort of text them in and ask those questions if in fact you are seeing something that you're wondering about. I encourage you to put that information into the chat window if you like it. Oh, I apologize. I just realized you're going to be watching this on a recording. So yeah, put them in the chat and I hope somebody else answers them because I'm not going to be able to answer them. Yeah. But here you can see that if you ride a gap down and you wait 3 days and then you buy in to the US stock market or to US stocks at all, then if you hold on to them, they will turn out to be a market beating kind of strategy. Here's one where I wasn't looking at all household names. I was looking at small caps that I knew had been around less than 10 years. And this has very similar, it takes a while for it to get up off the ground, but it does, and it separates. And when the separation comes, you can see it's all of the green is fully above all of the red. That's saying a lot for an S&P 500 stock. The idea that somehow you could find something that was going to make a big difference, right? So gaps down and then waits 3 days. Now, if you're watching the euro, you don't see that. You don't see that gap down, right? But that's why it's important to watch the S&P 500. If you watch the S&P 500 and you see a gap down in it, look and see if she's had 3 down days just previous. And that's kind of what that blue moving average is for on this chart, to just sort of keep you connected to that period of time. Now, if in fact you see the S&P 500 make a new low on Monday, then just recognize that, hey, this chart sort of told you the way. It's going to be to the downside for a while. But how would you know when it was time to kind of overcome that and turn around and go bullish? Because it'll start fast and you got to catch it fast. One thing that I think you can do is zoom out here. Okay. One thing you can do is draw a horizontal line from the places where the dip occurred. That one right there, see how that comes down? I'm trying to get that line to just fit in there, and I can't seem to move it. Horizontal line. Well, what I'm trying to get to here is, do you see how this line, if I can make it move just a little lower, that's what I want to do. Or delete it and let me start over. Better not do that. I can't seem to, okay, I'm just gonna have to go with that. You draw this line, I'll draw a second one underneath it. There we go. And you see that the price isn't there yet. It's got a little bit more ways to go. But once it does, it's a good bet that somewhere in this range. So that's what we want to find. We want to find that moment where, hey, where do we see a big reversal? Now we can go long. Until then, we're just going to stay playing it short, right? And that's what I'm suggesting, is that you might be able to be watchful for that in the week ahead as the euro begins to get to these lines. This is, I don't know if you can see them, it's 1.0475 and 1.04460. Okay, well, in that range, 1047 and 1044, that's where I think you can watch for reversal signals. It might happen as quickly as next week on the Euro USD. Okay. Oh, yes. And one more thing here. If in fact you see the euro go down on 2 or 3 of these candles during the hours where the US market is closed, well, then you know it's going to create a gap. There will be a gap in prices on the US S&P 500 if in fact there's a weekend slide or an early Monday morning or Sunday night slide on the euro USD, right? And then you can come in there and check and see what exactly is possible for potential rebound. So we want to see a gap down, and we want to see 3 more days, and then we want to see the possibility for a reversal in a support zone identified by the chart, 1047 and 1044, 1044.5, 1044.59. So it's more like 6. Okay, 10446. at 1047. All right. If you were watching out for those sometime during the week to come, good for you. But you probably have your own sort of trading strategies already set up. And I'm just going to say with that, until we see each other again sometime soon, hopefully, take care, everyone, and trade well. Sometime soon, hopefully.